All right. In exercise 17-13, we're going to have net operating loss carry forwards. And so this is more likely what we'll be seeing as long as they don't change the tax law, like I mentioned before. And so we have year one, we had a loss of 380,000, and year two, we had a loss of 135,000. And so I'm going to go ahead. It doesn't actually ask for this, but I'm going to go ahead and calculate the deferred tax asset that is available for year one and two. So 380,000 times 0.34, and that's going to be $129,200. And so that's year one. In year two, we had a loss of 135,000, and the tax rate stayed the same at 34%. And I get 45,900, and that's going to be our deferred tax asset. And so, to do the journal entries for the year one would be deferred tax asset for 129,200 and income tax benefit for 129,200. And of course, year two would be the identical amount. But the reason I wanted to do this is I want to create a T account over here. And so this is our deferred tax asset, DTA, our deferred tax asset. And so I'm going to have 129,200, and I'm going to have 45,900 here. And so that comes to a total of 175,100. On that so far. All right. So now we get to year three, and we have 425,000 of actual income before tax, right? And so year three, we would have 425,000 times 34%. And so our income tax expense on that would be 144,500. All right. And so we also have to keep track of how much of this carry forward we have used. So we're going to use another T account here. And we have a loss of the 380 and the 135. All right. Now, as we do this, one of the things that happens is you go to the oldest loss and you use that up first. So we've got the 425, and we use the 380 first. And so essentially, we wipe out that 380 that we had before. And that's going to give us 145,000. Okay. and 145,000. That is, I'm sorry, 45,000. Knew something wasn't clicking in my head there. All right, so that gives us 45,000 remaining that we're going to use. And so we use that, and that takes us down to zero income for tax purposes. So now our entry in year 3 is going to be income tax expense, the 144,500 that we calculated, and we're going to have the deferred tax asset. So we're writing that down for 144,500. We put that up here, and we get a new balance. And that gives us 30,600 that remains in our deferred tax asset account. So now year 4 comes along, and for year 4, we end up showing 585,000 of income, and that's going to be times the 34%. And we get an income tax expense of 198,900. All right, so we take the same 585, and now we subtract the remainder of the carry forward, which will be 90,000 on that side, and we're going to use it and zero that out, and that's going to give us 495,000. So this is our income tax expense. We're going to multiply that times the 34% rate. And we get 168,300. That will be our income taxes payable. And so our journal entry will look like this. Income tax expense, $198,900. Deferred tax asset, 30,600. I put that on the wrong side, didn't I? 30,600. Now we write that off. And so we have a zero balance in our deferred tax asset account, and then the remainder will be income taxes payable. And that'll be the 168,300. And so 198,900. And so it balances. All right. So that concludes exercise 17-13.